Since 2021, the concept of a private credit fund has become extremely popular in the pooled fund world. These include funds that are investing in different kinds of bonds issued by companies. So, what is the meaning of private credit? What is unlisted debt? What is listed debt? Where does the debt get listed, anyways? Let's explore all these concepts in this video. I'm your learning partner, Sushila Hariharan. Subscribe to my YouTube channel if you want more content centric, research focused videos on hedge fund accounting, hedge funds, private equity investments, investment banking, and trade operations. A private credit fund is a pool of funds which comprise capital contributed largely by limited partners and run by the general partner. The GP, the general partner, runs the AMC, that's the asset management company, and like every other hedge fund structure, it's similar in the structure format where the LP contributes capital and GP provides the operational assistance. Banks provide a broad spectrum of loans. If a company wants a loan, it can go to a bank, which can give its term loans typically for durations of 3 to 5 years. It can also be given a loan of financing working capital requirements, which is more like a 12 to 18 month loan. So when a corporate needs financing in the form of debt, they first approach their banks, and banks give them these kind of loans. The second way they can raise capital is from the bond markets. A bond, as you know, is a marketable instrument that is a debt obligation from the issuer to the investor. We have different types of corporate bonds which are marketable and tradable. And because they are tradable in the OTC market, the ownership can be transferred from the seller to the buyer, and hence these instruments are also called as negotiable instruments. So the first two approaches that a corporate takes is bank lending, and the second one is issuing bonds. The third type, which has become very popular now, is to issue non-tradable bonds, unlisted bonds, to separate institutional investors. So how is this different from bank lending? Bank lending is specifically only for working capital financing or term financing, and it need not be via bond issuance. But on the other hand, private bond issuance is specifically issued as a bond to a select group of investors. These bonds do not get listed, and hence they are called as private credit. And remarkably, the same thing is the term used for private debt. So private debt analysts research different kind of bonds that are companies that are going to be issuing bonds. They analyze the bonds, and then they evaluate and decide whether the credit worthiness of the issuer is worth it. The three ways in which private credit funds finance assets is: first is asset financing, the second is direct lending, and the third is special situations. As you know, asset financing is for specific acquisition of a particular project or an asset. The second one is for investing in different types of loans, and the third is for the same as mentioned. The bonds can be senior bonds or subordinated bonds depending upon what is mentioned in the loan agreement, that is called as the indenture. As we already discussed, senior bonds are those that get the priority in claims during bankruptcy, and only after senior bondholders are paid, subordinated bondholders are paid. This brings us to the next concept. Can private bonds be issued by listed companies? Of course. Listed companies means they're listing their equities. Okay, so both unlisted as well as listed companies can issue private bonds, which are then placed with private credit funds. All right, this helps us to understand what is the concept of ratings. As we know, in the bond world, ratings are the most important criteria for evaluation of creditworthiness. In this case, ratings are not mandatory. The term sheet is then signed by the fund and the investing company. The term sheet also is followed by the indenture. The indenture is the term that is used for the loan agreement between the issuer and the investor, and the indenture contains covenants which regulate the performance of the issuer as long as the bonds are still active between the different investors. So now let's take a look at what is the difference between the private credit and public credit. So private debt is non-tradable. The ownership cannot be transferred except from one institutional investor to another institutional investor. A public debt is tradable. The second difference between private credit and public credit is, in the case of private credit, ratings is not mandatory. In the case of public debt, ratings are mandatory. In fact, most regulators like SEBI, SEC have mandated that ratings have to be there for all listed instruments of bonds. The third difference is that the private debt is very illiquid in nature, and typically the private debt fund or the private credit fund holds on to the bonds till maturity. All right, but in the case of public debt, the liquidity is quite high. We'll be exploring more about this liquidity aspect in the later video. The fourth distinction is private credit is largely held by institutional investors. These include hedge funds, these include private credit funds, PCFs, amongst others, whereas public credit is largely held by retail and institutional investors. Thank you so much for listening in.